access to finance remains one of the biggest challenges facing small businesses in Kenya, especially for micro, small and medium-sized enterprises or MSMEs. Despite making up the vast majority of firms in the country, many still struggle to secure affordable credit due to limited collateral, high risk and information gaps. Let's take a listen to a presentation addressing this issue.
I'm here to kickstart a debate on an interesting, but quite not really new, but an interest angle to supporting MSME financing. So let me begin by quite an observation that has been made for some time now about the importance of SMEs, and I don't think I need to spend a lot of time. In the morning, I think one of the speakers mentioned that 98% of our farms are SMEs, so I really do not need to spend time here motivating the importance of SME. But also, this is from the World Bank Enterprise Survey 2018. Access to credit comes as a key, in fact, second key constraint of farms in Kenya. And so, once again, motivating why we should be interested in SME access to finance. So, SMEs have a few characteristics that are of interest to this study. One, of course, is the insufficient collateral, the high risk of default that they are exposed that characterize this sector. Of course, high transactional cost, and more importantly, the asymmetric information. What is the outcome of this is that, of course, limited access to finance, and we have seen that in the World Bank survey. They will be generally rationed, they will be charged high interest rate, and they may not have access to long-term financing. So the outcome of, the result of this is that we end up with an underdeveloped SME financing market. And this might require some intervention because we have some form of market failure here. So how does then a credit guarantee scheme works? I know because most of us here from the financial industry, we probably know, but just so that we are on the same page on what is our working definition. So in that picture you are seeing there, on one hand we have SMEs, and on the other hand we have banks. In between, you see hurdles which SMEs must jump to get to the other side to get help. And down there, then we have a third party, that's a credit guarantee scheme, which unlocks these hurdles and allows SMEs to access credit. And so the credit guarantee scheme comes and says, says to the bank, I know you may not lend to this SME, but can I guarantee that in case she defaults, I will be able to cover part of the loan. So, and hence the idea of partial credit guarantee schemes. So there is debate about these programs or these schemes. Globally, the evidence seems to be mixed. On one hand, there seems to be consensus that these partial credit guarantee schemes can reduce risk and can also expand lending. However, what is not clear is what's the impact in terms of pricing? Does the credit, the expectation is that the credit guarantee schemes should be able to lower interest rates to this, so that these SMEs can borrow at a lower rate than if the schemes did not exist. How does this guarantee scheme perform across sectors? That also is not conclusive. But also, there is an observation that if these credit schemes are not well designed, then they can fail. So, in the context of Kenya, we wish to understand whether high impact yet underserved sectors are benefiting from these credit guarantee schemes. Are borrowing costs meaningfully reduced?
My main comments, which I'll go in detail, are around the theoretical and conceptual framework. So as Mwalimu explained, the main idea is, do these partial guarantee schemes achieve an intended impact? But I feel that it really needs to be more of a development of like the theoretical and conceptual framework and kind of a theory of change of how you think the impact should be. And then when I go into the conclusions, I must say the findings are not unexpected. And whilst Mwalimu focuses on the comparative study and institutional design, I feel that this necessarily may not be the answer. Quickly, again, the title refers to pricing and risks, but the main issue that was discussed is defaults and borrowing costs. So I think this again ties down to my need to really focus in onto a theoretical framework. So once your research design is very clear, the independent and dependent variables are clearer, it will automatically kind of make the paper flow better and have a bit more kind of idea of like what is the key reasons why these partial guarantee schemes have not led to reduction in borrowing costs for the borrower. I feel that the theoretical framework needed a bit more development. When you read the paper, which is well written, there's a focus on things like information asymmetry. I'd like to contend that partial guarantee schemes do not reduce information asymmetry. The reason we need them is because banks have not been able to reduce the information asymmetry. So when you say that these are the channels, we really need a careful thought on what we see as the channels through which partial guarantee schemes can have different impacts. And when the dependent variable is access or defaults or borrowing costs, each has a distinct, maybe differentiating, mediating variables. And then that sort of conceptual framework then needs to be used to justify the model. Whilst I'm not saying that the fractional logic model is wrong, we can't just say you're using it because this data is between 0 and 1. Yeah? You need to have a theoretical reason why you're using that model. And for the borrowing costs as well. So it's not clear to me why no macro factors were included in the fractional logic model. And I'm not saying it's right or wrong, but I think it's like if it came from the theory, it would make more sense. And also, in the OLS model, I'm also not 100% clear how endogeneity is dealt with, because you have things like interest rate as independent variables. So there needs to be some sort of better explanation of that. And particularly in both the theoretical framework and the writing, there needs to be a discussion that this paper is looking at impact kind of on two sides. On the demand side, so banks don't want defaults, so it's trying to answer that question. And sorry, that's the supply side. And then on the demand side, borrowers want lower costs. So often these two sides get kind of confused when we're thinking of this kind of whole impact of partial guarantee schemes. So, and there needs to be a clear link of how the Kenyan context and the institutional design of the Kenyan context is taken into and shapes the model. The literature review, I know this is a new area, but I feel it needed a bit more depth, even the papers that were discussed. For example, one of the papers cited, similar to Kenya, has very limited pass-through of the partial guarantee schemes to borrowing costs. And this paper, according to the author, the reason is guarantee fees, administrative cost, and sector risk perceptions. But then we kind of make this jump to institutional design. So I feel, again, coming back, if we have these conceptual frameworks correct, and then we see, when we say institutional design, are we still talking about guarantee fees? It's a bit unclear. So in the Kenyan context, there's also limited pass-through, and then we say that's because of institutional design. But this jump of why, guarantee fees or administrative costs, there's some may or may not be part of this design is very important. And so I feel there needed to be explicitly a more, in the literature, a discussion of what is institutional design. I personally feel there's a big problem with calling anything international best practice. Yeah? There's nothing international that's best practice. Any kind of global standard, if we adapt it to Kenya, we need to see what is relevant for our context. So the literature review also has kind of completely ignored some of the political economy factors shaping partial guarantee schemes. And I think we need to move beyond some of these kind of institutional design as this sort of holistic thing, but also try to say what are the Kenya-specific factors.